But let's welcome on board Sunil Tirumalai then. Sunil, hi, morning. Great to be speaking with you. Can you hear me clearly?
Yes, I can hear you. Good morning.
Good morning. And Sunil, it's turned out pretty good from those March lows, right? We were just discussing that it's a near about over 8% recovery that the index alone has seen. Better for the broader markets and crude. I think that's the biggest tailwind right now. So far, so good, Sunil. But what next?
Yes, so I think it was fairly stressful 2 or 3 months with the Asia Middle East conflict, and I think, but interestingly, if you see, not just in India, across emerging markets, other emerging markets in Asia that I cover, we haven't actually seen too many downgrades on earnings through those 2 or 3 months. In fact, for a foreign investor, most of the downgrades for India EPS basically came from the currency rather than from like for like cuts to earnings for the companies. And if you actually look at the market movement as well, you mentioned March as a bottom, but I think basically from 8th or 9th of April, when the first ceasefire talks started, I think the market started believing that the ceasefire is just around the corner. So I think you're right. So crude prices coming under control, talks of further, expectations of further drop. I mean, all of those are, really good. I think, but in our conversations with investors, I don't think that ever became a very important factor. Most of the regional and Asia and emerging market investor focus continues to be on the AI theme, and there are some markets which are positioned better than the others.
Sunil, hi, morning. How do you look at India in that sense? Because from a macro point of view, the crude cooling off, inflation fears now ebbing, and earnings back to pre-West Asia crisis level. Means the expectations which are coming in from the Q1. Do you think that will bring some kind of flows back to India?
It's a very important question for the Indian markets perspective. I think we need to see, where India stands compared to other markets, because that's what a foreign investor who has options to invest in other markets looks at. If I compare the situation pre-COVID, let's say the period 2015 to 2018, 2019 versus now, there are a few ways in which India is actually relatively inferior compared to the others, right? I'm not just talking about AI. So AI is, one of the drivers, but if you look at earnings growth expectations, even keeping aside Korea and Taiwan, even markets like China and Brazil are actually giving you faster earnings growth for the next couple of years. Partly because of top line, partly because of margins expanding. I mean, there are some competitive pressures easing in some places, and they're seeing export markets and so on. So earning growth, where India used to be genuinely much faster than other emerging markets, you're actually slightly slower, compared to other emerging markets. I mean, even if you look at stuff like ROIC, India used to be at a lead compared to other markets. Now it is slightly lower. And other markets have generally gone up because of the benefits from AI. I mean, we've been seeing even this morning some of the memory stocks, that came up with their numbers in Korea. They are seeing a massive growth in the profits. I think that part is a bit missing. Valuations have derated to the rest of the emerging markets for sure. But what we see is that in our numbers, India still has about 50% premium. It peaked at about 110% in 2024. It's now down to a 50% premium, but still is a premium. The 50% premium is largely in line with what it was pre-COVID. So it's not very easy to make a strong positive argument. I think as long as the AI narrative stays driven by US capex and flowing through into North Asia tech, that story looks a bit more exciting. It's not that investors don't want to invest in India. It's just that there are better opportunities at the moment elsewhere.
Absolutely. And, you made a very valid point, Sunil, that EM investing is becoming less about, what you're seeing in terms of diversification or the valuation play, and it's just about AI. You think investors need to rethink perhaps as to why they own EMs in the first place?
Yeah, that's a very good point. And that's what we also kind of argued in the note that we put out. So historically, emerging markets were seen were sought for diversification, both in global portfolios and within the EM portfolio itself. What do I mean by that? Usually, when you want to own something other than the US, something away from the US, you would generally go to emerging markets because the rest of developed markets were highly correlated with US markets. So you didn't get anything different by going in other developed markets. The other point was also that emerging markets as an index itself was very diversified within many countries, many sectors, nothing very dominant and so on. But all of that has actually changed, right? I mean, just 3 stocks today account for close to a third of the index. That's even bigger concentration than what you see in the US index itself. And the correlation with the US has actually, hit very high levels, which basically means for an investor buying emerging markets, you're getting more of the same stories that are driving the US as well. So that has kind of had an impact. I'm not sure if that is the reason why EMs have been seeing net selling. I mean, that is a fact that overall, if I add up the flows into all the emerging markets, you've actually been seeing a negative number this year. It's not just for India. In fact, markets like Korea have seen record levels of selling, but that's technical reasons. I mean, many investors are unable to own stocks at these sizes because they're very large in their portfolios, and hence they are forced to sell. But the fact is, what you mentioned earlier is right. So emerging markets have become very concentrated, very resembling, what the US stands for, and hence, not much diversification. It's a different matter that today the market doesn't care about that because all everybody wants is just AI. But that benefit of diversification from EM is actually lost.
But do you think that also sort of leaves a lot more scope for disappointment? I mean, look what happened to Samsung, for instance. The revenues fell short of expectations. The stock was down 6% in one shot.
Well, okay. So given how these stocks are moving, I think a 5-6% up move down, even 10% downward, it's becoming pretty par for the course. I think there are a lot of technicalities in terms of positioning through leverage funds and so on. Taking a longer term window, I mean, these are stocks which are actually up 2.5 to 3x in the last 12 months. I mean, some stocks are actually up, 5x or 6x. On that scale, if you're losing 5%, I mean, we need to keep in mind that over the last 1 year, the kind of growth in revenues and profits that these guys have given. For us at UBS, we still see that there is a lot of room on the upside for many of these stocks from a fundamental perspective, right? So positioning and flows is one aspect, but fundamentals are still fairly robust, is how we are thinking about it. But yeah, I mean, the fact that it is concentrated as an index basically means that you're just relying on a few themes to carry you through, and there can be scope for disappointment. Having said that, there's also a significant shift in the profitability profile. Historically, the problem that we had with emerging markets, and that included India's contribution to the story that I'm going to talk about now, is that there was constant dilution of shareholder returns because companies made very low ROICs, and the markets themselves were very inefficient. You used to see very large IPOs, very highly priced IPOs, all of them diluting public shareholders. That was a problem with emerging markets, not with US or other developed markets. What we're now seeing is a decent shift or a turnaround in that story. Because of the pricing power shifting between the US hyperscalers and the Asia tech companies, we are seeing ROIC as well shift from the US to emerging markets companies. So that is basically meant that this year, YTD, emerging market EPS for 2026 and 2027 have seen anywhere from 30 to 60% upgrades, whereas the US has probably seen about 15 or 17% upgrade. So that is already showing up. We're also seeing a lot of restraint in terms of IPO activity across emerging markets. We see that even this year, even India has been, reasonably restrained in terms of the supply coming in. Of course, there are some pipeline ahead. That's also good. Whereas in the US, we are seeing a lot more. US, we're actually seeing companies who used to do buybacks earlier, like the large hyperscalers, now beginning to do equity capital raise to fund their capex. So the entire capital allocation, story is shifting in favor of emerging markets, and I think that's something that something that the market should like.
think, Sunil, you spoke about the fact that there's using upgrades for emerging markets, but within emerging markets, do you see India continuing to have that nominal growth of 10 odd percent and still attracting enough foreign flows? Given the fact in the last 2 years, India's weightage in MSCI emerging market has fallen from 22 odd percent to 10% now.
Yes. So, I think it's very useful and important to keep track of the trends on the nominal GDP growth. That to some extent drives top lines, profits, and so on. But we also need to acknowledge that the nominal GDP growth rate right now is slower than what it used to be, let's say, over the last 20, 25 years. I think barring the COVID period, you're probably touching the lows in terms of nominal GDP growth, which then means that it's not looking very different from what some of the other EMs are able to give you, right? A 9 to 10% is still higher than most other EMs, but earlier India used to gap of at least 4 or 5% premium on nominal GDP growth than some of the other markets. So to some extent, the premium for India is justified, but the premium you could argue should be smaller than what it was in the past. But as I said, earlier, I think with the war firmly behind, markets should be getting focused back onto fundamentals. If I look at stuff like earnings growth forward outlook or where the ROEs are headed or the ROICs are headed, it's not that India is seeing a sharp degradation. I mentioned about the earnings upgrades. Many markets, not just Korea and Taiwan, have seen upgrades. There are markets in LATAM and EMEA for various other reasons, non-AI reasons, which have actually seen upgrades on earnings. For now, India is still missing out on that part.
You look at global markets as well. Japan is something which is closely being watched because of the kind of pressure which is coming on the currency, intervention expected, but it hasn't come in yet. If that comes through, you're going to have a different kind of cycle with respect to outflows coming in from some of the emerging markets. How do you look at that as well?
Okay, so let me give a general view on the developed markets space, right? And of course, Japan is a decent part of it. I mentioned earlier that all of emerging markets have actually been seeing outflows. Some of it genuine selling because people don't want to own those markets, but also because people are forced to sell in some of the markets where the stocks have become very large. But we continue to see the rest of the world want to own more of the US. And I think the rest of the developed markets are pretty neutral that way. I would say on fundamentals, even within Japan, it is a lot of it is the AI related stocks that are finding a lot of interest even within our UBS analyst ratings universe as well. And most of those are facing the US driven AI demand. So yeah, I think from a global equity allocation perspective, we still see more money going into the US. The world wants to own more of US assets, including US equities. There does not seem to be a lot of change in that. And yeah, I think those companies are still giving you growth. They are still giving you top line growth. Those companies are still giving you good ROIC and returns. There are questions being asked about the scale of capex that they're doing into AI, and so on. But if you look at where the flows are, global funds still want to own and be part of that story, a lot more.
Okay, so diversification clearly is it for the Indian investors. But within India, Sunil, what are your sectoral overweights and underweights?
Well, I think looking at the ones which we like, I think banks are clearly making a lot of sense today. They are one of the few sectors which are cheaper than their own history. A setup which is basically some trailing effects of inflation sticking on is generally helpful. Higher rates for longer, which is a global call that we have at UBS, that's also generally helpful for banks. What we've also seen is that the credit growth is picking up to to us, that is basically a shift in market share from the bond market to the banking system in terms of loans and corporate loans. And again, higher bond yields, will always be helpful towards that. And we are not really worried about much of asset quality, issues. So I think banks, some of the larger private banks, are something that our team likes. After that, I think you start getting pretty specific and bottom up. Some of the recently our team did a lot of work on the metals and mining space. Some interesting stories over there. Power and coal. It is a continuous story where there will be demand, there will be build outs, and that can be helpful. And there are a lot of interesting ideas in the mid and small cap space as well. Some of the work that our teams have done. I think, but banks to me present the most interesting opportunity at the moment.
Sunil, if you look at maybe a month back, it was widely anticipated that there could be a tightening of interest rates, firming up of interest rates, which will happen. But because of the resolution which has come in, do you think that now the central bank action may be much more, relaxed rather than increasing rates across the board, whether it's in India or in the US or other developed markets?
No. So I think the short answer is that, on a global scale as well, or in Asia or in India, we're not talking about a quick easing cycle. Some of these inflationary pressures tend to persist for a while. So we need to see how that, really plays out. Even in the US, our team's view is that you're likely to see a higher for longer situation. The first rate action that they're talking about is sometime in 1Q or 2Q of 2027. Given some of the commentary coming out from the new Fed chairman, the market seems to be thinking that there are more hikes probability than a rate cut probability. I would say even in India, I don't see a case for a very quick rate cut scenario, because, as I said, some of these inflationary pressures do tend to persist. We are yet to see the worst of El Nino impact on inflation, that usually hits with a lag of 6 to 9 months, and has a big impact on food inflation, which is important for the CPI in India and so on. So I don't think we are calling for rate cuts in most markets anytime soon.
Interesting. Sunil, great to have you today on ET Now. Thank you so much for your time.